Most investors believe failure comes from bad timing, poor stock choices, or market crashes. But the truth is much simpler and harder to accept. The main reason most investors fail is not the market, but their own behavior. This one factor quietly destroys results over time. It does not look obvious, and it often feels justified, but repeated consistently, it prevents wealth from growing and turns opportunities into missed potential. The one thing most investors fail because of is inconsistency. They invest when they feel confident and stop when they feel uncertain. This breaks the compounding process. Wealth is not built through occasional action, but through repeated, disciplined behavior over time. Without consistency, even the best strategy cannot produce strong results. Another part of this problem is emotional decision-making. Fear and excitement influence actions more than logic. Investors buy when prices are high because they feel confident, and sell when prices are low because they feel afraid. This cycle repeats again and again, quietly reducing returns and preventing long-term growth. Trying to time the market makes this problem worse. Many investors wait for the perfect moment to invest. While they wait, their money is not working. Markets move unpredictably, and missing just a few strong growth periods can significantly reduce overall results. Another mistake is stopping during downturns. When markets fall, many investors pause or withdraw money to avoid losses. This reaction feels safe, but it locks in losses and removes the chance for recovery. Staying consistent during difficult periods is what allows long-term success. Another factor is lack of discipline. Even good strategies fail without consistent execution. Discipline ensures that investing continues regardless of emotions or market conditions. Another reason investors fail is constantly changing strategies. They start with one approach, then abandon it when results are not immediate. Each new idea feels better, but constant switching prevents progress. Compounding requires time and consistency. Without it, growth never has a chance to build momentum. Investors who stay committed to a clear plan achieve far better results than those who keep restarting their approach again and again. Many investors also underestimate the importance of compounding. At the beginning, growth appears slow and insignificant. This leads to frustration and doubt. However, compounding accelerates over time, turning small gains into large results. Those who stop early never reach this stage. The key is patience and consistency, allowing returns to generate more returns over long periods. Another problem is overtrading. Many believe that being active in the market increases returns. In reality, frequent buying and selling increases costs and leads to poor timing decisions. Each trade reduces overall performance. Investors who focus on long-term positions and avoid unnecessary activity often achieve better results. Ignoring fees is another hidden reason for failure. Small costs may seem unimportant, but they accumulate over time and significantly reduce returns. Management fees, commissions, and hidden charges quietly eat into profits. Reducing costs allows more money to remain invested and grow through compounding. Another mistake is failing to reinvest profits. Dividends and gains are often spent instead of being reinvested. This interrupts compounding and limits long-term growth. Reinvesting returns allows wealth to build faster and more efficiently. Another factor is waiting too long to start investing. Many people delay action because they want more money or better conditions. This delay reduces the time available for compounding, making it harder to achieve strong results later. Another reason investors fail is lifestyle inflation. As income grows, spending increases at the same pace or even faster. Instead of directing additional money into investments, it is used for comfort and consumption. This prevents wealth from building, no matter how much is earned. Investors who control lifestyle growth and prioritize investing are able to accumulate assets over time, while others remain financially stuck despite higher income. Another hidden factor is lack of clear goals. Without a defined financial direction, investing becomes random and inconsistent. People invest without knowing why, and this leads to poor decisions and lack of discipline. Clear goals create focus and motivation, making it easier to stay consistent even during difficult periods. When results are not immediately visible. Another problem is reacting to news and market noise. Investors are constantly exposed to opinions, predictions, and headlines designed to create urgency. Reacting to this information leads to impulsive decisions that disrupt long-term strategies. Successful investors filter noise and stay focused on their plan, instead of reacting to every change. Another mistake is not increasing investments over time. As income grows, contributions should also grow. Many investors keep investing the same amount while spending more. This slows wealth accumulation and limits the impact of compounding. Increasing investments allows growth to accelerate and strengthens long-term financial progress. Another reason investors fail is avoiding risk completely. Keeping money in low-return assets may feel safe, but it prevents meaningful growth. While risk must be managed, avoiding it entirely limits potential. Balanced risk is necessary to achieve long-term financial success and build wealth effectively. Another hidden issue is overcomplicating investing strategies. Many investors believe success requires complex systems and constant adjustments. This leads to confusion and inconsistency. Simple, structured approaches are easier to follow and more effective over time because they support consistent behavior. Another major reason investors fail is focusing too much on short-term results. They check their portfolios daily and react to every small movement. This behavior creates stress and leads to unnecessary decisions. Short-term volatility is normal and often meaningless for long-term growth. By reacting to it, investors disrupt their strategy and reduce their chances of success, preventing compounding from working effectively over time. Another issue is not having a structured plan. Without a clear system, investing becomes random and inconsistent. Decisions are based on emotions, opinions, or trends instead of logic and discipline. A structured plan defines contributions, allocation, and long-term goals. This structure allows investors to stay consistent and avoid mistakes that come from uncertainty or impulsive behavior. Many investors underestimate the importance of starting early. They believe they can invest later and achieve similar results. However, time is the most valuable factor in investing. Starting early allows compounding to work for longer, creating stronger results. Delaying even a few years significantly reduces final outcomes and makes it harder to build meaningful wealth over time. Another problem is focusing only on income instead of investing it. While learning more is important, it does not create wealth on its own. Without investing, money does not grow. Many people increase their income but also increase their spending, staying in the same financial position over time. Investing is what transforms income into long-term financial growth. Emotional reactions during market downturns often cause major losses. Fear leads investors to sell in order to avoid further decline. However, selling during these periods locks in losses and removes the chance for recovery. Markets historically recover, but only those who remain invested benefit from that growth. Staying consistent during downturns is essential for long-term success. Another costly behavior is constantly changing strategies. Investors move from one approach to another, chasing better results. Each change resets progress and prevents compounding from building momentum. Consistency is essential for long-term growth, and frequent changes reduce effectiveness and increase the risk of failure. Ignoring inflation quietly destroys wealth. Even if money appears stable, its purchasing power decreases over time. If investments do not grow faster than inflation, real value is lost. Many investors overlook this factor and focus only on nominal returns, which creates a false sense of progress while actual wealth declines. Another mistake is relying on luck instead of discipline. Some investors hope for one successful opportunity to change everything. While occasional gains may happen, they are not reliable. Sustainable wealth is built through consistent actions, planning, and discipline over time, not through unpredictable outcomes. Stopping investments during downturns reduces future gains. Lower prices often provide better opportunities, but fear causes many investors to pause or withdraw money. Continuing to invest during these periods strengthens long-term results and allows investors to benefit from market recovery. Another issue is not reviewing investments periodically. Without review, portfolios can become unbalanced or misaligned with goals. Regular adjustments help maintain stability and manage risk effectively. Ignoring this process can reduce performance and increase unnecessary exposure. Failing to build strong financial habits limits growth. Investing should become a routine, not an occasional action. Habits create consistency, and consistency drives long-term results. Without strong habits, progress becomes irregular and unreliable. Lack of patience is one of the biggest reasons investors fail. Many quit before results become visible. Early stages often feel slow, but growth accelerates over time. Those who stay consistent benefit the most, while those who quit remain stuck. Another critical reason investors fail is not automating their investments. When investing depends on memory, mood, or timing, it becomes inconsistent. Some months are skipped, others delayed, and progress becomes uneven. Automation removes this problem completely by creating a steady system. Regular automatic contributions ensure that investing continues without interruption, even during busy or uncertain periods, allowing compounding to work continuously and build long-term growth more effectively. Another hidden issue is wasting unexpected income. Bonuses, gifts, or extra earnings are often spent immediately on short-term desires instead of being invested. This is a missed opportunity. Allocating unexpected income into investments accelerates growth and strengthens compounding. Over time, these additional contributions can create a significant difference in total wealth, helping investors reach financial goals faster and with greater stability. Lack of long-term planning is another reason investors fail. Without a clear vision, financial decisions become reactive instead of strategic. Investors move from one idea to another, never building a stable foundation. Long-term planning provides direction and purpose, helping investors stay consistent and align their actions with meaningful goals. This clarity improves discipline and increases the likelihood of achieving lasting financial success over time. Constantly changing strategies prevents real progress. Each time investors switch their approach, they reset their results and interrupt compounding. Growth requires time and stability. Investors who frequently change plans never allow their investments to mature, limiting long-term outcomes. Staying committed to a well-structured strategy is essential for building momentum and achieving meaningful results over extended periods. Focusing too much on short-term performance creates stress and leads to poor decisions. Daily market movements are unpredictable and often irrelevant to long-term growth. Reacting to them causes unnecessary changes that reduce returns. Successful investors ignore short-term noise and remain focused on long-term progress, allowing their strategy to work effectively over time without disruption. Lack of discipline is one of the most important reasons investors fail. Even the best strategy cannot succeed without consistent execution. Discipline ensures that investing continues regardless of emotions, distractions, or market conditions. It transforms intention into action and action into results. Over time, disciplined behavior creates stable growth and strengthens long-term financial success. Not understanding compounding limits potential. Many investors underestimate how powerful reinvested returns can become over time. Compounding starts slowly, which leads to doubt and impatience. However, it accelerates significantly with consistency. Those who interrupt the process by stopping or changing strategies never experience its full effect, while those who remain committed benefit from exponential growth. Ignoring small habits reduces long-term success. Small actions such as saving regularly, investing consistently, and avoiding unnecessary expenses may seem insignificant at first. However, repeated over time, they create powerful results. These habits form the foundation of wealth. Without them, progress becomes unstable and unreliable, limiting the ability to build meaningful financial growth. Seeking shortcuts is another reason investors fail. Quick gains are attractive, but they usually involve higher risk and instability. Many investors chase these opportunities, hoping for fast success. Instead, they often experience losses that delay progress. Sustainable wealth is built through steady and disciplined investing, not through risky shortcuts that promise immediate results. Quitting too early stops progress completely. Many investors abandon their strategy before results become visible. The early stages of investing often feel slow and unrewarding. However, this is the phase where compounding begins to build. Persistence is required to reach the stage where growth accelerates. Those who quit early miss the most important part of the process. Not adapting gradually can reduce effectiveness. While consistency is essential, small adjustments help maintain balance as income, goals, and market conditions change. Ignoring these adjustments can lead to inefficiency or unnecessary risk. Smart investors refine their approach over time without abandoning their core strategy. Maintaining stability while improving performance. Expecting fast results leads to disappointment. Investing is a long-term process, but many people expect immediate success. When results are not visible quickly, they lose motivation and stop. Understanding the timeline of investing helps maintain patience and commitment. Long-term thinking is essential for achieving meaningful financial outcomes. Comparing yourself to others creates unnecessary pressure. Every investor has a different timeline, strategy, and level of experience. Trying to match others often leads to risky decisions and inconsistency. Staying focused on your own plan improves discipline and allows steady progress. Comparison distracts from long-term goals and reduces effectiveness. Fear of making mistakes prevents action. Many investors hesitate because they want certainty before starting. This delay costs valuable time and reduces the impact of compounding. Taking informed action is more effective than waiting indefinitely. Experience gained through action improves decision-making and builds confidence over time. Overreacting to market changes leads to unnecessary losses. Markets naturally rise and fall, but reacting to every movement disrupts strategy. Emotional decisions often result in buying high and selling low. Staying calm and consistent protects long-term growth and improves results. Not increasing investments over time limits potential. As income grows, contributions should also grow. Many investors fail to adjust their investing levels, which slows wealth accumulation. Increasing contributions strengthens compounding and accelerates progress toward financial goals. The real difference between successful and unsuccessful investors is behavior. Discipline, patience, and consistency create wealth, while emotional decisions and inconsistency destroy it. Long-term success depends on habits, not on finding perfect opportunities. Most investors fail because of one thing: inconsistent behavior. Not the market, not the strategy, but their actions over time. Those who fix this one issue and stay consistent begin to see steady growth, while others continue repeating the same mistakes and never reach their financial potential.